Attention to the west of the continent now, looking at the NSE All Share Index over in Nigeria. The market here starting 2010 off on an upward trend, the index gaining 8.2% in January. But on closer interrogation, you'll notice that roughly 72% of those gains were made in the first half of the month, with the index now seeming to have gone into a holding pattern, trading in a very tight range. Yet, we're hearing reports that major international institutional investors outside Africa are now back into Africa with the major investments in capital markets, specifically Nigeria. So let's hone in on activity we're seeing here with Bismarck Rewane. He's CEO of Financial Derivatives. Bismarck, thanks so much for joining us this afternoon. Well, what evidence have you seen of institutional investors, foreign institutional investors, coming back into the Nigerian market?
At this point, it's actually very mild investment interest and appetite. But to the extent that the volumes that are being traded are so low, any interest whatsoever becomes kind of magnified because of its strategic importance. But we've noticed that a few people are now beginning to take positions, primarily for three main reasons. One, they believe that the political situation in Nigeria is about to be resolved. Two, that the Nigerian economy would probably recover along the lines of the global economy. And three, that the banking sector reforms and resolution is going to lead to the recapitalization of certain banks and offer some tremendous opportunities in that particular sector.
While there is this exuberance out there, though, I mean, there's enormous X factors at play on a global scale. We're, of course, looking at uncertainty regarding the pace of the economic recovery on the one hand. Locally, there's this leadership vacuum. You say, investors are confident that the political climate is about to see some resolve in the near future. But for now, we're looking at many getting pretty nervous about the possible headwinds that this leadership vacuum that currently persists would pose for reforms in both the oil and banking arenas. So what risks are these investors facing in your books?
I think, one, the risks have already been priced into the market in the sense that you consider the stocks are relatively cheap and rich. But you see, the tendency is always to buy on the rumor and sell on the news. There are all sorts of rumors and other factors that are driving the investment decisions at this point. But I must caution that what you're seeing is initial trends. There are no massive volumes right now. If you look at the books of the pension funds, they are so underweight equities. In fact, total exposure to the equity markets are something like almost 5% of their total of their assets under management, while they're keeping about almost 80% in bank deposits and treasury bills. So there's a lot of opportunity to come back into the market in a big way. And that's what people are anticipating and taking positions in advance.
So let's take a look at some of the opportunity that has opened up. In your books, where are some of these buying opportunities at this stage?
The buying opportunities, obviously, as you know, the bank's shares have been slaughtered over in the last year, and there's some opportunity there. They're trading at multiples that have never been heard of. They're very low PEs, trading at some of them at one-time book or 0.8 book. In the beverage sector, there are a lot of opportunities there. The construction and real estate, construction and building material sector, there is in the telecom sector as well, there is some opportunity there. So all across the value chain of different industries, there are opportunities. And the market as a whole, it's at trading on 5.5 trillion. The market had peaked at about almost 12.5 trillion about 8 months ago. You mentioned that the market has actually gained about 8% this year. But if you look at the volumes being traded, and before it stalled, those volumes are still pretty little compared to the typical trading averages that we had about a year ago.
Well, although the NSE All Share Index is showing indications at this stage of a breakout, I mean, it's having problems breaking above its 200-day moving average, and you've cited just one problem, that volumes are still pretty low at this stage. Breaking above the 200-day SMA, though, and sustaining it will demonstrate technically that the index is no longer in a bearish mode. What's your outlook for the NSE over the next 6-month period?
Well, let me say that my outlook is that the NSE will probably, I see market capitalization at about almost 7 to 7.5 trillion in the next 3 to 6 months. And I say this because I think the Asset Management Company Law Act is going to be passed into law very soon, maybe in the next 4 to 5 weeks. When that happens, it's going to be a catalyst and put some momentum into the market. So what you have is now there's value. Strategic investors will see opportunities as well. Value investors will see some bargains to be picked up. And then because of the momentum and the catalyst effect of the AMC, where some banks will sell their toxic assets into the market and create some more room, you would, I think that those are the various the ingredients that will lead to some recovery in the market. But having said that, even at 7 trillion, which is something like almost 40% from where it is today, that is way, way below where it should be or where it could have been. The market is so grossly undervalued at this point in time. But also, please know that it's not all stocks that are going to be moving up. I think it's going to be those with opportunity, those with strong management, those that are strategically positioned, yep, and those that are not vulnerable to either political risks or exchange rate exposure.
So those with strong fundamental backing. On that note, let's leave it there. Bismarck.